Hey, Ryan. Honestly, after the last couple of years working on the podcast, I never thought I'd actually be on the show, but here we are.
There we go. So Scott's going to be just kind of hanging out in the background, and then he's going to be kind of making sure that I'm steering the ship in the right direction. Because what we're going to be doing today is we're going to be diving into exit options, and I'm going to be pulling stuff from the intentional growth training, so that way we can set the stage for these next handful of interviews in a fun way. So that way we can get right into the meat and potatoes of each of these interviews that I'm going to have. So before I jump into this episode and the 5 different exit options and kind of giving an overview of those, the interviews to come, I'm super pumped about. So we have Brent Beshore from Permanent Equity, who's going to be talking about private equity and his unique structure. We have Tommy Mello, who is going to be speaking about strategic buyers, and he has been rolling up these garage door companies across the country, and it's just one heck of a character, and it's got a lot of cool stuff to be talking about. We also have Walker Diabo, who wrote the book Buy Then Build, who's going to be talking about search funds and acquisition entrepreneurs and how they're going about buying companies. And then we have a woman named Rachel, who is in a family business, a very large family business, and how they went through their transitions. So lots of fun stuff to come, but I wanted to set the stage of what do we mean by exit options and why do they matter? And I'm gonna share my screen, so the people that are listening in, I'm gonna make sure that you can listen in and not have to be watching the video. But the people that want to check out the YouTube video, I'm gonna be sharing just a little bit of stuff, so that way it gives a little bit more color to the things that we're doing. So, or things that we're talking about. So when we talk about principle 3 of the exit options, this has been an interesting topic for me for this last 6.5 years, because people think about, hey, I'm going to, exit options, I shouldn't think about till the moment that I want to sell. We've covered that in the last few mini series, where you're running an asset, you want to view and run your company as a financial asset. So therefore, if you grow it, you're going to have lots of choices. And we want to make sure that we understand the different choices that we have, so that way we can be marching towards something, knowing that we want to create the options that are available to us, versus waking up one day saying, hey, I'm burnt out and I want out. So before we jump into each of the 5 exit options, I just wanted to note that we have to be viewing these exit options through the lens of principle 1 and 2, which essentially are the mini series that we just went through. What do you want from your business and why is principle 1? What are your drivers? What do you want out of your lifestyle, or your timeline? What do you want out of the impact that you want? How do you want to have fun? Really putting some thought behind that. And then principle 2, what are your financial targets? Pat and I talked about 3 of them. Your annual income, the wealth outside your business, and what is this business worth as an asset, and how do you grow that asset? And now that we've got that kind of that foundation, remember we talked about having the separation of ownership versus management. So you have a W-2 job that you get paid for doing whatever you're doing. And then you have this asset that you're an owner of, where you have equity in it and you want that equity to grow. We have to separate those two, because, Scott hears me say this all the time. When people call me and I get these phone calls every week, like, Ryan, I want out. I'm like, out of what? Your job or this financial asset? And like, what do you mean? And I'm like, well, I don't get a lot of phone calls of people going, yeah, I want out of this asset that kicks off $1 million a year in mailbox money, because it's a good asset and obviously it's working. Generally, what people do is that when they call me and they say that comment, I want out, it's because everything's falling on their shoulders. They got to hold all the stress and responsibility of keeping the machine going. And it's the job that they're burnt out on. And they don't know how to get on top of that cash flow stream and get into that ownership box, or the visionary ownership box, as EOS talks about it. So we need to use this as a lens, not only principle 1 and 2, but then this ownership versus management roles, which now, there we go. I switched the slide. And this ownership versus management roles, like I was saying, you can have equity in a company and not have a job. Private equity, that's an entire industry, and that's what they do, is they buy companies and they place people inside of those companies, or they back management. And also you could have a job, but then also not have equity in that business. So we have to think about principle 1 and 2 and ownership versus management as we look at the 5 different exit options. So what I'm going to do is I'm going to quickly just list the 5 different exit options, and I'm going to, and the whole point of this episode is, again, to set the groundwork, so that way we can talk about these with more context as we have these other interviews that are coming up. So what I'm going to do is I'm going to walk over the 5 different exit options for the people that are listening in, And again, the purpose of this is I want to give some context behind each of these exit options. And then that'll hopefully make the next handful of episodes way more impactful because you're going to understand where they fit and the things that you should be thinking of when you're considering whether that's appealing to you down the road or now or whenever the time is right for you. So the first one, the type of exit options is internal, and that is managers, family members, partners. The second exit option is what we call acquisition entrepreneur, also known as search funds or entrepreneurship through acquisition. There's a lot of different terminologies going on. And those are wealthy individuals who wanted to buy a company, corporate refugees, as we like to call them. And again, we're going to dive further into all these in a little bit. The third one is ESOPs, which people hear me talk a lot about, and that is employee stock ownership plans. And that's the employees participating and benefiting from the ownership via an ESOP trust. And then the fourth one is private equity. And those are professional investors that are going out and buying companies for a rate of return. And then the fifth one is strategic buyers. And those are people that want to get into different geographic locations. There's a lot of different reasons a buyer would want to buy you. We did not cover IPOs, initial public offerings, because this is this show and what we're doing is for privately held companies who want to grow value, treat their company as an asset. There's a whole market behind, raising money for startups and then going and trying to drive to an IPO. That's different. And we're not going to be talking about that right now. And a little bit of backdrop on how Pat and I decided to land on these 5 different exit options. One is that, there's almost an infinite amount of ways you could structure your ownership sale and or what you could do with your job. But that doesn't do us any good because we need some sort of framework to understand what our basic choices are. So what Pat and I did, we sat down and we said, okay, there's about 17 attributes, and all this is in the intentional growth training if everybody wanted to check it out. But there's 17 attributes from your probability of getting your cash up front, high, medium, or low, your probability of controlling the entire process, and your degree of control, high, medium, or low. Your ability to reliant on like an earnout or some sort of creative deal structure. There's a lot of different nuances from each of these. And so again, we categorize these almost like dog, cat, goat. We're trying to say, okay, hey, yes, there's a lot of different variations, but generally this is a dog. And so that's what we're trying to do here. So between the 5 of them, it's internal, acquisition entrepreneur, ESOP, private equity, and strategic buyer. So each of these, what's unique about each of these is they're going to impact your W-2 role, your management role differently. And they're also going to impact how you monetize the sale of your ownership in the asset and the deal structure. So I'm going to just do a quick flyby on each of these. And Scott, feel free to jump in at any point just to make sure that I'm staying on track. And then what we're going to do with these other episodes is we're going to dive further into these with the people I mentioned at the beginning of the show, where they're going to describe why they decided to either go the route that they did, or if they're the business buyer, how they structure the deals, what they have as for the purpose of the acquisition. So you're going to be able to see it through the buyer's eyes of what that means to them and how you can align what you want with the goals of the buyer and the deal structure. All right. So with internal, the first one, and this is a financial sale. So again, there's another layer on top of this that's in the screen share that we have is in internal. It's a financial sale most often, and that is the intrinsic financial value of a company based on the risk of the cash flow. If you wanted to go check that out, there's the podcast that we did a couple of series ago where it's intrinsic financial value. We covered that in great detail. But the overall deal structure is based on the risk of the cash flow, and the company's cash flow has to essentially pay back and be able to afford the purchase price. So these are typically managers, family members, partners, and your degree of or your probability of getting all of the cash up front is very low unless they go and take out an SBA loan or if they've got a bunch of money themselves. A couple of things to note, you've still got to pay your taxes and you still got to fund your growth. So there's a math equation, as Dave Deal and I talked about in that one episode, where you have to figure out if this is something that you're interested in. Your degree of control is pretty high. You're going to have a pretty good understanding of what the people are going to do with the company afterwards. But your ability to get all your money up front is pretty low. But or what degree of or percentage of the money up front, and making sure that you feel confident that you're going to get the money over time, whether it's a promissory note or however the structure is. But again, internal, there's a lot of different people that it could be. It's based on the risk of the cash flow because it's an intrinsic financial sale. And there's a lot of different nuances to think about in your financial targets, whether that's something that's interesting to you or not. The second exit option, as we mentioned, it's acquisition entrepreneurs. And, it's so fascinating. This entire industry has exploded because a lot of millennials or Gen X's, and it's not necessarily age related, but people like, Minnesota, we've got like 19 public companies. Someone that ran the 3M division that's doing 50 million that wants to go out on their own and buy a garage door company or buy a CPA firm, or because they were in finance. I don't know there's a lot of different examples, but it's someone that wants to take over and, essentially not only buy a job, but then have that financial asset that they can grow by having a job. And that's what we call the corporate refugee. And then these acquisition entrepreneurs, when Walker Diebold comes on, there's these programs going out in these Ivy League schools now teaching people how to buy companies. And so someone, that could come out of Yale and they've got a bunch of student debt. They don't have a pot to piss in for wealth, but they have the skills, hypothetically have the skills to run a business. So what they're doing is there's this whole market now where these people that are kind of they call it the horse, right? Because these family offices or wealthy individuals or capital is backing the horse. So they're essentially saying, hey, if it was Scott's going to buy a company. I might have a bunch of money. I'm going to say, all right, Scott, what's your expertise? We're going to give you a year or two to go find a company, and then we're going to buy it because we have capital. We're going to have some equity and some debt. And then we believe that Scott's going to be able to grow that asset so he can have some wealth, and then we get a rate of return. So kind of a couple of different flavors of the acquisition entrepreneur.
Does an acquisition entrepreneur typically want the owner to stick around for a while?
Yeah, great question, Scott. No, I shouldn't. I said that pretty quick, but I would say it depends. But generally, if someone is going to go in there, it's going to be, hey, you know what? We have a vision for this company, and we want to take it to our own direction so we can grow wealth between the person that's going to be the CEO and then the money behind them. Generally, there's a different vision. So that's a wonderful point, Scott, because when you think about your principle one that we talk about a lot, what do you want for the future of the business? And what kind of say do you want into it? And like, if you really want to put in direction or into a specific direction, the future of the company, it's going to take a lot of dialogue with these people to make sure that they see the company the same way that you do, because you're probably not going to be sticking around a lot. I wouldn't be surprised if you went through a bunch of data and said, okay, well, a certain percentage of those CEO or those owners stick around in some capacity, whether it's an earnout or an employment contract. But it's always tough because if the visions aren't aligned of what to do with the company long term, there's going to be friction, and like it's hard. I can't imagine going and buying a company and having the old guard sit around for a long time, and everybody's trying to look and who's running this place. So I think just the potential for conflict is so high that, and generally people just want to cash out because it's like they're cashing out of their job and the company right around the same time. That a lot to talk about, and that's why we're going to get into this with the different interviews, but lots to know and to think about based on principle 1 and 2. And we are on to ESOPs and employee stock ownership plans. Everybody hears me talk about it a lot. We've had Dave Deal from Prairie Capital and dozens of people on this show talking about ESOPs. In a nutshell, it's an ESOP trust that ends up buying the company, buying the shares of the EIN number, and then the employees get a benefit of that employee ownership through the ESOP trust. Once that company, if it's 100% ESOP owned, and I think the stat is right now that 90% of all conversions into ESOPs, 90% of them are 100% ESOP. So you could do a partial ESOP, but in this example, if you do 100% ESOP, the company no longer pays federal or state income tax. So there's a lot of additional cash flow to service the debt. And so with an ESOP, you can generally get between a third and a half of your money up front from a senior lender like a bank, and then you're going to carry the note afterwards. And it's truly just an ownership transition. So you've monetized the business. It does not change your operations or executive team at all. So if someone calls me up and says, I want out, and if they're referring to their job, an ESOP is not going to be great because nothing changes operationally. It's just a way to monetize the business. So again, the benefits of an ESOP over an internal transition is you're not going to be paying any taxes, so it frees up a little bit more cash flow to service that debt, allowing you to grow a little bit more and potentially faster. Again, different pros and cons between all these, and that's why understanding principle 1 and 2 is so important about what do you want and what is attractive of these to you. I would say that if you wanted to monetize your business and have a liquidity event, but still enjoyed running the leadership team or being a CEO or whatever, it's a great option to have some financial reward and monetizing it while also still participating in the business long term.
With an ESOP, so there's some like good tax opportunities or like good tax breaks with it. But if I'm the owner and I sell my equity in the company, do I still have to pay taxes on that sale price?
Great question. It's a stock sale, so it'll be capital gains. So yes, you'll have to pay taxes on that. There's a lot of nuances called the 1042, where if it's a C corp, you could actually take that money and put it into stocks that are like a like investment, kind of like a 1031 exchange. But there's not a lot of C corps out there, and a lot of people go, "Well, I should turn into a C corp," and then 5 years later, then I can, it generally is not worth the conversion to a C corp, and then to do that to avoid the tax on the sale. But the overall net proceeds over the structure of an ESOP, because you get some upfront, you get mezz financing rates over the course of the seller's note, and then some things called warrants, potentially could be higher than any larger purchase price because of the net proceed comparison of the deal structures of like a strategic or a private equity sale. Great question though. And so again, we've covered internal, which is a financial intrinsic sale for the most part. 2 is acquisition entrepreneur, also typically a financial intrinsic sale. And then 3 is an ESOP, again, intrinsic financial sale. And I'm saying that because the valuation methodology is primarily based on the discounted cash flow, which is based on the risk of the cash flow, which is what we've been hammering through over these mini series for many months now. That leads us to then exit option number 4, and that is private equity. And this can both be strategic and financial as far as like how the valuation is determined. But if you can justify the valuation of your company based on the risk of the cash flow, I would say that should be your backstop, even with private equity, because they're in the business of understanding assets, cash flow, and risk. So if you know your shit, you'll be able to go head to head with these people and say, here's exactly what we want and why and how all this works. And you should be able to justify that, and they'll probably respect you for it. There's a lot of strategic reasons a private equity firm might want to pay a premium if you're what's called the platform. And again, we're going to be diving a lot of this stuff later, but a platform meaning that it's going to be the first company you're going to bolt on other companies to that platform. The platform company might get a lot more money. The big thing with private equity is understanding how long have the general partners been doing this? Where do they get their money? What's their hold period of the fund? And then making sure that you know how many times they've done this. Like, are you in fund 1 or are you in fund 15? And how long is the timeline till they have to sell all of the companies? Because if they have to sell them all next year and they're buying you right now, there's certain implications for your company. A lot of private equity firms, they want to make sure that you're rolling some equities, so that you're going to get paid out a certain amount of money, and they're going to want you to reinvest back in. I mean, there was one gentleman on the podcast, and he was saying that he rolled up, I think it was like 100 companies he'd bought, and he said he would never buy a company where the owner would want to roll less than 25%. So call it 25 to 49%. And the private equity's job, their goal is to get a rate of return. So they buy companies, they grow them by increasing the EBITDA, increasing the multiple, and paying down debt and selling it with a certain period of time. Brent B. Shore is going to be on the show to talk about how his structure is different and a lot of different flavors that are available out there nowadays. And what's another interesting category inside of private equity, Paul Moffat's going to be back on the show, and he's from a family office. So family offices are essentially just really, really, really rich people that they have a bunch of people managing their money that are just not in ETFs and in a Schwab account. They say, I want to go invest in private equity, and they can choose to go give a private equity firm some money. So the private equity firm goes and buys the companies and manages them, or the family office could choose to go buy the companies directly and have people manage it. Couple different ways, and I think it's important to know, and we'll be comparing those two with Brent B. Shore and Paul Moffat and kind of other options as far as like, what does that mean to you as far as your legacy? What are they planning on doing with the employees? a lot of family offices don't make you roll a bunch of money because they don't want you to have the upside. So it's a lot of succession planning, I think, is where they just want you, they're helping you get out and monetize your company and get out of your job. So and we've talked a lot about PE firms in the years where they've raised like 1.5 or $2 trillion. It's already committed capital. So this money has to be spent. They're charging the investors 2% on their money, and they get usually a percentage of the upside, 2 and 20, so 20% of the upside. They have to spend the money and go buy companies. So you're seeing these valuations still stay pretty high because the money's already committed, regardless of what's going on in the public markets. So kind of just fascinating. The private equity firms have been going down market to try and buy smaller companies because there's not a lot of good companies to buy in the middle to upper market. So you're watching private equity go down. You're watching smaller PE firms pop up that have raised $40 million instead of the typical like larger ones that are a couple hundred million. If you've seen one private equity firm, you've seen one. There's like 8,000 private equity backed companies in the US, and there's only 3,900 some public companies. So it's a huge industry. It's in the business of buying companies to grow them and sell them at some point. It's just better to understand this, because if you understand this sector, you can compare and contrast the different people you're probably getting phone calls and emails from. And then that leads us to the fifth exit option, which is strategic buyers. And I like to joke around about this one because most strategic buyers these days are like, there's a good chance they're backed by private equity because they could be the platform company, but then there's someone that actually is behind them, which is the private equity firm. The thing is strategic buyers, everybody listening in knows exactly what they are for the most part. It's the people that it's a short list. If you could think about the people that should buy your company for the strategic reasons, that's exactly what we're talking about. Large competitors. It could be people that want to get into the geographic market that you're in, synergies where they don't, you can cross sell the different products and services, supply chain, vertical integration. There's a lot of the, Amazon FBA account companies that, they're now getting into manufacturing. Manufacturing is now getting into Amazon. So you're just watching the vertical integration that makes the overall entity and cash flow less risky and therefore a higher valuation. A lot of strategic buyers, and I didn't mention this on private equity too, but we could talk about this for days and we're not going to, but that's why we're going to have all these other episodes. But the role, like how each of the private equity and strategic buyers impact your role depends. Strategic buyers, that's who we sold to. And it's look at the redundancies and figure out who's needed. And then the strategic buyer has a specific reason they're going to buy your company. And I suggest you go listen to my interview with Ted Schluter, where we were talking about strategic buyers and kind of the purpose of what they're looking at. And Tommy Mel will be talking about that as well. What they want to do with the business will impact your role. And if you don't figure out what they want and what the new org chart is going to look like based on them buying you, you just don't know. And it's not your company anymore. So I would highly recommend getting as deep as you can to figuring out what do they want with your company and why. But you have a higher probability of getting all your cash up front. There's potential earnouts and stuff like that. But if you think about the difference between the internal and strategic, which I think a lot of people think are the only two options, it's either take your money over time, long, dramatic, conflict ridden with partners and family, or gut the company and sell to a strategic buyer and regret it. I'm being dramatic here to show you the bookends of, the spectrum, but that's what people think. But there's an infinite amount of ways to structure your ownership sale, and how there's a lot of different ways to handle your role. It all depends on what you want. And that kind of leads us into, things to consider as we're wrapping up here. What do you want? And I mean, I hate to always go back to this, but like, what do you actually want? What do you want from your business and why? What do you want from your role over time? And what do you want from your ownership? What's your timing? What's the bogey that you want for the valuation? And how does that impact your legacy or culture, employees, and what you want? And then that's all in principle one. And then principle two is your financial targets.
For what do you want from the business and why? So I have a question because I find myself asking this question all the time. So once a week, every week for the last couple of years, I hear you say, what do you want from the business and why? But how specific on that question do you recommend like a business owner get with that? Like what, do you know what I'm asking?
Yeah. It's as specific as people can is my recommendation, because if it's like I really like the services I'm building out, but I want to monetize this, and I want to make sure that my services and that the impact that I'm having in this industry live on without me. Okay, there's a certain set of things that happen with that. Or I love being the leader. I don't want to be the CEO anymore. I don't want to deal with all the operational BS. I don't want to deal with all my headaches, but I want to do sales or I want to be an engineer, and I still love this company. I just don't want that. It's like just really writing down like what brings you joy? What do you enjoy about your job? What do you enjoy about the business? What don't you enjoy about it? Putting it down, because at any point, if someone's going to buy your company, put all this stuff in the purchase agreement and the employment contracts and the operating agreement. If you're part of it, like the more intentional you are because you understand what you want, the higher the probabilities you're going to get it because you put it into the agreements or the negotiations. And I think, Scott, it's just different for everybody. And unless you know you're not going to have an idea of how you're going to negotiate it. Like, I'm just making something up, but someone said like if someone was going to talk about shutting down a division or, moving the location or whatever it is, if you don't know that that's important to you and all of a sudden you say, no, I don't want to do that. And then the price goes from 10 million to 7 million. I don't know. How does it impact you? Can you still be financially free? Is that still viable? It's just the people don't understand the trade-offs and the financial implications of the trade-offs because they haven't determined what's important to them and how that impacts their financials.
And I just like Principle One a lot. So another thing, and maybe this is just for the listeners, or maybe you want to elaborate on it too, is we had an episode with Rob Dubay about 10-year thinking. And I think one thing that I think about a lot is like if you put what do you want from your business and why as like a short-term way of thinking, and then you use Rob Dubay's 10-year thinking, I think that's a good like approach to, not feeling left with regret after you sell or whatnot.
Yeah, and I hear what you're saying, and I think doing, what do you want from the business? Why short term, but also like for me, I've got a 10-year plan for, like when Rob and I were talking about it on that episode, and it's not specifics. Like it's like I want the freedom of time, the freedom of relationships, freedom of purpose, and it's a lot of this, a lot of these concepts from Dan Sullivan's new book, Who Not How, but it's not like I'm not like so granular that I'm going to be, stressed out if I don't hit it, because it's more about having choices in the future and like what brings you joy. What brings me joy is doing podcasts, speaking, like watching other people succeed. It's not doing pivot tables. I got a team for that. And so my point is like in your role, what do you want? The freedoms that you want, and then using that as a filter. So if someone has an offer in any of these different options, your partner wants to buy you out, you get an out of the blue offer, you go to an ESOP conference or webinar and you're going, what does this mean to me? You look down and say, well, this is what I like. Great. And then you look over to the right and say, okay, now the financial targets, what does this financially mean to me? I think the biggest challenge that a lot of people have is they don't have that clarity that says, I have two options right now. One is for 10 million, one is for 8 million. And this is how both of those impact my role now and in the future, the company now and in the future, the culture now and into the future, and says, okay, well, like now I've got a decision-making framework, and how important are those things are to sacrifice potentially a couple $1,000,000? I don't know. Like, do you need the couple million or not? Or like, if you're totally wealthy outside the business and this is way above your financial freedom number, maybe say, heck with it. That's the way, doing an ESOP instead of a third-party sale is the way of accomplishing my legacy, my philanthropy, whatever. Or you don't have the options and you have to sell to a strategic because you need the money, you don't have the time. But at least you know that, hey, I'm going to be sacrificing these things and I don't have a choice, but I'm okay with it. I've come to peace with that versus doing it, regretting it years later and having a podcast 8 years later like me. so I think as we're wrapping up here, I just wanted to set the stage for these other podcast interviews, because this stuff is complicated, but it doesn't have to be. And as long as we have a framework of like thinking about these options and understanding how it impacts the value of the asset, the deal structure, when and how you monetize it, and your role pre, during, and post closing, and depending on what's important to you, you can get straight to the questions that you need answers to. So that way you don't have to drag out for years of like, hey, maybe someday I want to sell, the rolling 5-year exit plan. No one even knows what that is when they say, I want to sell in 5 years. What do you mean by that? they kind of just look at me and I'm like, bah. Yeah, because they don't know all the options. They don't know the impact of their options. So hopefully this is a good good foundation for the next few interviews. I wanted to mention an announcement. We have a physical in-person boot camp coming up, which I'm super pumped about. First one in almost 3 years. It's at Bethel University in Minnesota. It is on November 2nd and 3rd. And it's $5,000 for the first ticket and half off the tickets after that. We max out at 20 participants, and super excited. Where this principle that we just talked about, this exit options, I think is like over like a half a day. So we're whiteboarding about private equity. We're whiteboarding about ESOPs. We're having a lot of conversations and exercises to help people understand truly what it means, and using the 2 case studies as a way to show relativity of how different people and different companies and sizes are able to get what they want based on the actions that they're taking. So very excited for it. And again, looking forward to the next handful of interviews. And I think that is about it, unless I think Scott's got one more question.
I have one more question for you. What does the word intentional mean to you?
Figure out, what do you want long-term? What's important to you? And then build a plan to get it, and take deliberate and purposeful action every day to be closer towards that goal that you have. And because you're intentional, you have an idea of how the the decisions you have to make today are going to impact that long-term plan, whether it's you're getting closer or further away, because you've got a framework and a filter to say, okay, well, this situation in front of me is going to help get me closer because I'm intentional. I know what I want and why, and I'm taking action towards it.
I've always been excited to ask you that question.
And we have done it. So I think everybody has probably heard enough of me for now. Thank you so much, Scott, for sitting there so I don't have to talk to myself and keep me in the guardrails a little bit. And everybody make sure to check out the boot camp again.